What if I told you that the American dream might be quietly draining your wealth for 30 years, and you don't even realize it? Almost every middle-class family in America celebrates the day they sign their 30-year mortgage. The house keys feel like freedom. The photos, the smiles, the congratulations. It feels like you've made it. But behind that celebration is a financial contract designed to keep you in debt for 3 decades. And the shocking part? Most people never calculate what it actually costs them. The 30-year mortgage is often marketed as the safe option. Lower monthly payments, easier approval, more affordable. But affordable compared to what? The trap doesn't show up in the monthly payment. It hides in time and interest. Let's say you buy a $400,000 home with a 10% down payment. That means you borrow $360,000. At a 7% interest rate over 30 years, you won't just pay back $360,000. You'll pay back over $860,000. That's $500,000 in interest alone. $500,000, not for the house, but for the privilege of borrowing money slowly. Here's where the trap tightens. In the early years of a 30-year mortgage, almost all of your payment goes toward interest, not principal. That means you could live in your home for 5, even 7 years, and barely reduce what you owe. If you sell early, most of the money you paid didn't build equity. It paid the bank. The bank gets paid first. You get leftovers. And psychologically, the low monthly payment makes you comfortable. It stretches your budget just enough to feel manageable, but long enough to lock you in. You may think it's just like paying rent, but here's the difference. With rent, you can leave. With a mortgage, you're tied to market conditions, property taxes, insurance increases, maintenance costs, and economic downturns. One job loss, one recession, one housing crash, and suddenly that safe payment doesn't feel safe anymore. Then there's opportunity cost, the invisible wealth killer. If you invest aggressively in your 20s and 30s instead of locking cash into a long-term mortgage, compound growth works in your favor. But when most of your income goes toward housing, you lose investing power. That $500,000 in interest, if invested in the stock market over 30 years at historical average returns, it could potentially grow into well over $1 million. Instead, it becomes the bank's profit. The trap isn't that mortgages are evil. The trap is believing that a 30-year mortgage is automatically the smartest choice. Banks prefer 30 years because it maximizes interest. Real estate agents prefer it because it expands your buying power. But buying more house with lower monthly payments often means sacrificing long-term wealth. You feel richer today while becoming poorer tomorrow. And here's the deeper issue: inflation and lifestyle creep. When people buy homes based on what they can afford monthly, they stretch to the edge of their income. That leaves little room for investing, business building, or financial flexibility. You become house rich and cash poor. On paper, you're building equity. In reality, you're stuck in a 30-year commitment that limits risk-taking and slows wealth acceleration. But the most dangerous part of the 30-year mortgage trap is how normal it feels. Everyone does it. Your parents did it. Your friends are doing it. It feels responsible. It feels adult. And that's exactly why no one questions it. When something is socially accepted, it rarely gets audited. So the real question isn't, is a 30-year mortgage bad? The real question is, who benefits most from you staying in debt for 30 years? You or the bank? Now let's talk about the illusion that makes the 30-year mortgage feel like a wealth-building machine: equity. You've probably heard it 1,000 times. At least you're building equity instead of throwing money away on rent. It sounds logical. It sounds responsible. But what most people don't realize is how slowly equity actually builds in a traditional 30-year loan. In the first decade of a 30-year mortgage, the amortization schedule is brutally skewed toward interest. That means even though you're writing that check every single month, a large percentage goes straight to the lender. In year one, the bank is collecting interest at its highest level because your loan balance is at its highest. Only a small fraction chips away at the principal. So while you feel like an owner, financially you're still very close to being a renter with a liability attached. And then there's appreciation, the other illusion. Yes, historically, real estate tends to rise in value over long periods, but appreciation is not guaranteed. Markets cool, prices correct, interest rates spike. If you bought at the peak of a market cycle, it could take years just to break even after transaction costs, closing fees, agent commissions, repairs, and maintenance. The home might go up in value, but your actual profit after 30 years may be far less dramatic than people imagine. Let's not forget the hidden costs that never show up in the mortgage calculator. Property taxes rise, home insurance premiums increase, maintenance never stops. Roof replacements, HVAC systems, plumbing issues, appliances, landscaping. Homeowners spend thousands every year just to keep the property functional. Over 30 years, these costs can add up to 6 figures. When people compare rent to a mortgage payment, they rarely add these expenses into the equation. The mortgage isn't the full cost of ownership, it's just the starting point. Another layer of the trap is mobility. A 30-year mortgage ties you geographically. In today's economy, flexibility is power. The ability to relocate for a higher-paying job, start a business in another state, or pivot industries quickly can dramatically increase lifetime earnings. But when you own a home with a large mortgage, every move becomes complicated. You have to sell, pay commissions, hope the market cooperates, and potentially buy at higher interest rates. That friction keeps many people stuck in average income brackets simply because moving feels financially overwhelming. Then there's inflation, which most people misunderstand. Inflation can reduce the real value of your fixed mortgage payment over time, which is one argument in favor of long-term loans. But inflation also increases your cost of living, taxes, insurance, and maintenance. So while your principal and interest payment may stay fixed, your total housing cost often climbs steadily. The predictable payment story isn't as stable as it sounds. Let's zoom out even further. The average American moves every 5 to 7 years. That means most people never hold a 30-year mortgage for 30 years. They refinance, they upgrade, they relocate, and every time they reset into another 30-year loan, the clock restarts. More interest, more fees, more decades of payments. This is how a 30-year mortgage quietly becomes a 40 or 50-year interest cycle across multiple homes. And here's the subtle psychological factor. Once people buy a home, they feel financially accomplished. That sense of achievement can reduce urgency around investing, increasing income, or building businesses. The house becomes the centerpiece of their financial identity. But real wealth is not built by one asset tied to debt. It's built through cash flow, ownership of appreciating investments, scalable income streams, and disciplined capital allocation. The 30-year mortgage isn't automatically a mistake. For some people, it creates stability and long-term appreciation. But when it becomes the default strategy, without understanding the math, the opportunity cost, and the long-term trade-offs, that's when it becomes a trap. Because the real danger isn't the interest rate. It's the decades of financial energy redirected towards servicing debt instead of building true wealth. So if the 30-year mortgage can quietly drain hundreds of thousands in interest and limit your financial flexibility, why does almost everyone still choose it? Because it solves a short-term problem while creating a long-term commitment. It lowers the monthly payment, it gets you approved, it makes the numbers work, and in the moment that relief feels powerful. But financial decisions made for comfort today often cost freedom tomorrow. Let's compare it to a 15-year mortgage. The monthly payment is higher, sometimes dramatically higher, which scares people off immediately. But here's what most don't calculate. A 15-year loan at the same interest rate can cut total interest nearly in half. That's not a small difference. That's potentially hundreds of thousands of dollars staying in your pocket instead of flowing to the bank. And because more of each payment goes toward principal from the very beginning, equity builds much faster. You're not just making payments, you're actually owning more of your house sooner. Now imagine an even more aggressive strategy, buying below your means. Instead of stretching for the maximum loan you qualify for, you deliberately choose a smaller home, a cheaper neighborhood, or a property that allows you to live far below your income level. That single decision can unlock massive investing power. The money not spent on housing can be redirected into index funds, retirement accounts, businesses, or other appreciating assets. Over decades, that difference compounds into real wealth. But here's the truth most people avoid. The mortgage isn't the problem. The problem is buying based on approval instead of strategy. Banks calculate how much debt you can handle. They do not calculate how much wealth you could build if you avoided that debt. They optimize for their profit model, not yours.